Welcome back to the channel, traders and market enthusiasts. Today, we are opening up one of the absolute best modern guides to trading global currencies ever written. We are taking a comprehensive, story-driven deep dive into the art of currency trading by Brent Donnelly. If you have ever wanted to know how an actual senior interbank trader views the global financial markets, manages millions of dollars in risk, and consistently extracts profits from foreign exchange, you are in the exact right place. Grab your favorite drink, settle in, and let us break down this masterclass in modern trading. Brent Donnelly is not an internet marketer selling a secret course. He is a veteran professional trader who spent decades sitting at senior trading desks for major global institutions like HSBC, Citigroup, and major hedge funds. His book stands out because it blends high-level macroeconomics, practical chart reading, positioning analysis, and strict risk control into a complete, repeatable trading system. By the end of this video, you will understand how to view the currency markets through the eyes of a true Wall Street professional. The reality of the foreign exchange arena. To succeed in trading currencies, you must first understand the true environment you are stepping into every single morning. Donnelly begins by pulling back the curtain on the global foreign exchange market, which is the largest and most liquid financial market on Earth. Unlike equity markets, where individual stock prices are driven by company earnings reports and corporate balance sheets, the foreign exchange market is an arena where entire national economies compete against one another. Every currency trade is inherently a pair. You are never simply buying an asset in isolation. You are simultaneously buying one currency and selling another. This fundamental reality means that currency movements are driven by relative economic performance, relative interest rates, and global capital flows. When you trade the euro against the United States dollar, you are making a direct bet that the macroeconomic story of Europe will outperform or underperform the macroeconomic story of the United States. Donnelly emphasizes that retail traders often fail because they treat foreign exchange trading like a basic video game. They slap two indicators on a short-term chart and expect to make a fortune. In reality, you are competing against central banks, multinational corporations, sovereign wealth funds, and veteran interbank traders who have access to massive information networks. To survive and thrive in this environment, you must build a structured, multidimensional framework that covers every angle of the market battlefield. The four essential pillars of currency trading. The foundation of Donnelly's approach rests on what he calls his primary analytical framework. To achieve a consistent trading edge, you must align four critical pillars before taking any serious market position. These four pillars are macro fundamentals, technical analysis, positioning and sentiment, and market intelligence or news flow. Macro fundamentals answer the question of why a currency should move over the medium to long term. They give you the directional bias. Technical analysis answers the question of where and when to enter or exit. It provides the precise timing, structure, and risk levels. Positioning and sentiment reveal how the market is currently leaning, showing you whether a trade is overcrowded or widely ignored. Finally, market intelligence keeps you aware of immediate catalysts like breaking news, central bank speeches, and economic data releases that can spark sudden momentum. When all four of these pillars align in the exact same direction, you have found a high-probability trade setup. If macro fundamentals are screaming to buy a currency, technical charts show a clean breakout from a solid base, market positioning is light, and upcoming news catalysts favor the move, you have a classic professional trade. Donnelly teaches us that taking trades where these pillars conflict is simply gambling with poor odds. Mastering macro fundamentals and central banks, let us take a deep look at the engine that drives major currency trends over weeks, months, and years. Macroeconomics and central bank policy. Donnelly makes it crystal clear that interest rate differentials are the absolute primary driver of currency exchange rates. Capital around the world naturally flows towards safety and higher yield. If a country's central bank is raising interest rates while another central bank is cutting interest rates, global investors will sell the low-yielding currency and buy the high-yielding currency to capture that return. This brings us to the importance of understanding the central bank reaction function. Central banks like the Federal Reserve, the European Central Bank, and the Bank of Japan operate under specific mandates, usually focusing on inflation control and economic employment. As a currency trader, your job is not to guess where inflation is going in 5 years. Your job is to understand how central bankers will react to the next set of economic data reports. If inflation data comes in unexpectedly hot, the central bank will likely become hawkish, signaling future interest rate hikes, which naturally causes the domestic currency to rally. If economic growth is collapsing, the central bank will become dovish, signaling rate cuts, which weighs heavily on the currency. Donnelly advises traders to build an economic calendar matrix, tracking central bank expectations and noting whether upcoming data points are continuously beating or missing market forecasts. When data consistently surprises to the upside, a powerful, tradable trend is born. Practical technical analysis and chart mechanics. While macro fundamentals provide the big picture direction, technical analysis is your primary execution tool. Donnelly treats technical analysis with a pragmatic, no-nonsense attitude. He warns against cluttering your charts with dozens of complex mathematical indicators that create confusion and decision paralysis. Clean, simple charts are far superior. The most effective technical tools in currency trading are classic horizontal support and resistance levels, multi-month trend lines, and simple moving averages like the 50-day and 200-day lines. Horizontal support and resistance levels are exceptionally powerful because they represent historical price points where real buyers and sellers stepped into the market with significant volume. When a major horizontal level breaks decisively, it often triggers a cascade of stop-loss orders and fresh momentum entries, creating explosive price action. Donnelly also highlights the importance of analyzing multiple timeframes. A professional trader always starts with the big picture, looking at weekly and daily charts to establish the dominant market trend and locate major key levels. Once the macro trend and major levels are identified, you drop down to 4-hour or 1-hour charts to fine-tune your exact entry point and set tight stop-loss orders. Technical analysis should never be used to predict the future. It should be used to define your exact risk relative to your potential reward before you ever click the trade button. Market sentiment positioning and liquidity flow. One of the most valuable chapters in Donnelly's book deals with positioning and sentiment analysis. Understanding how other traders are positioned in the market gives you a massive tactical advantage. When a trade becomes completely overcrowded, meaning almost everyone in the market is already long or short, the potential for a violent reversal becomes extremely high. To track market positioning, professional traders analyze weekly reports like the Commitment of Traders Report published by the Commodity Futures Trading Commission. This report shows the net long or short positions held by large institutional speculators and commercial hedgers. If institutional traders are holding near record short positions in a currency, any piece of positive news can trigger a massive short squeeze, forcing them to rapidly buy back their positions and driving the price sharply higher. In addition to formal reports, Donnelly encourages traders to monitor retail sentiment gauges and market commentary. When retail traders are overwhelmingly bullish on a currency pair, it often serves as a powerful contrarian signal. If everyone who wants to buy has already bought, there are simply no buyers left to push the price higher. The street-smart trader looks for opportunities to enter trades where positioning is light, or to fade markets that have reached extreme, unsustainable levels of crowd consensus. Bulletproof risk management and trade execution. You can possess brilliant macro analysis and clean chart setups, but without bulletproof risk management, you will inevitably blow up your trading account. Donnelly dedicates significant attention to the mathematics and psychology of risk control. In the world of professional interbank trading, managing downside risk is the absolute top priority. The first golden rule of risk management is defining your exact exit point before you enter the trade. You must know where your stop loss is located and exactly how much money you stand to lose if the trade fails. Donnelly strongly advocates for sizing your positions based on volatility rather than fixed lot sizes. A currency pair that moves 200 pips a day requires a much smaller position size than a quiet currency pair that moves only 50 pips a day to keep your actual dollar risk identical. Another critical concept is maintaining a positive risk-reward ratio. You should consistently seek trade setups that offer at least 2 to 3 times your potential risk in expected reward. With a proper risk-reward structure, you can actually be wrong on more than half of your trades and still maintain a highly profitable portfolio over time. Donnelly also warns heavily against holding losing trades past your predefined stop-loss out of pride or hope. When a market hits your stop-loss, it is telling you that your thesis was incorrect. Accept the small loss immediately, preserve your capital, and move on to the next opportunity. Daily routines and the trader playbook. A recurring theme throughout the art of currency trading is that consistency in results comes from consistency in preparation. Professional trading is an elite performance discipline, much like professional athletics. To operate at your peak potential, you must establish structured daily routines and maintain a detailed trader playbook. Donnelly outlines a comprehensive daily ritual for currency traders. Every morning before the market opens, you should review overnight price action. Scan global equity and bond markets for sentiment clues. Check the economic calendar for upcoming high-impact releases, and review your open positions. You should write down a brief daily game plan, outlining your primary trade ideas, key technical levels, and potential risk events for the session ahead. Furthermore, you should build a personal playbook of favorite trade setups that suit your personality and edge. Whether it is a central bank policy divergence trade, a technical breakout strategy, or a positioning squeeze setup, document the exact criteria required to enter, manage, and exit each trade type. After every trading week, conduct an honest review of your performance. Log your winning and losing trades, Analyze your mistakes and continually refine your execution based on real data from your own performance history. Final thoughts and key takeaways. Brent Donnelly's The Art of Currency Trading is a masterwork that demystifies the complex world of foreign exchange and replaces market myths with actionable, professional wisdom. It bridges the gap between high-level macroeconomic theory and real-world trading desk execution, providing a realistic roadmap for anyone serious about mastering the currency markets. To wrap up our summary today, remember that successful currency trading requires a balanced approach. Align your macro fundamental bias with clean technical chart setups, keep a close eye on market positioning, and enforce strict, unyielding risk management rules on every single trade you execute. Master your daily routines, maintain your emotional discipline, and treat trading as an ongoing process of continuous refinement. Thank you so much for joining me for this deep breakdown today. If you found real value in this story-driven summary, please hit that like button, subscribe to the channel for more deep financial breakdowns, and drop a comment below sharing your biggest takeaway from Brent Donnelly's framework. Trade smart, protect your risk capital, and I will see you all in the very next video.